Live from Bloomberg World Headquarters in New York, I'm Romaine Bostick.
I'm Joe Weisenthal.
Let's get you caught up on where we stand in financial markets. A rally around the world. The S&P 500 ending the year at a record high.
The question is, what'd you miss?
Joe, we did it, I think. We're just a few hours away from closing out a historic year, a year, of course, that a lot of people aren't going to forget for a wide variety of reasons.
I think I'll remember this one.
Okay.
I think I'll remember.
Well, investors, they're going to remember this. I mean, This is definitely one of the best years on record, no matter how you slice it, despite all of the volatility, despite that massive drawdown we saw in the S&P 500 and the rest of the stocks back in March and April. But at the end, it all sort of shook out, and a lot of opportunities were made, a lot of fortunes were made, Joe.
No doubt about that. A lot of fortunes were made in an extraordinary year. If you had just looked at the news, it's kind of cliche to say you would not have anticipated it. But yes, absolutely, lots of fortunes made all across different asset classes. Huge ETF inflows, highest since 2017, and really one of the highest of the last decade, as you can see there. People just loved stocks. They started buying them at the end of March. They were buying them before the crisis. They started buying them, though, again at the end of March, and they really did not let up, essentially, at any point. There was almost never a chance to catch your breath or catch up with this market from then on.
Yeah, and if you want to know anything about ETFs, probably the best person to talk to, at least here at Bloomberg, is Eric Balchunas of Bloomberg Intelligence, who knows this better than anybody else. Eric, let's start off with, I guess, the ETF du jour, and that is ARK.
Yeah, to me, this was the story of the year. I pronounced the death of the rockstar PM. I did not think we would see this. I thought quants and themes and all this stuff would take over, but here we are with an actual human being rockstar PM in Cathie Wood. And look, this fund company went from $3 billion at the beginning of the year to $35 billion. That's a 10 times increase. And they took in the most flows outside of any issuer, outside of Vanguard, BlackRock, and State Street. That is a crazy feat considering they started the year as the 29th biggest issuer. So for a stock-picking, high-cost indie issuer, it was just extraordinary, and you couldn't take your eyes off of it. And obviously, it was a killer performance. I mean, you talked about the Qs having a great year.
Yeah.
Her funds tripled the Qs. I mean, and it was like, how could that even mathematically possible? I just think looking forward with her, you got to ask how big can she get, and will that harm her ability to be nimble? Also, history is littered with these high flyers that come down to earth pretty hard. Janus 20, the currency hedged craze from 5 years ago. We'll see what happens, but it's going to be something that we're watching next year as well.
What about copycats? Will we see, because at least it was doable that a human could manage an actively managed ETF, attract attention, attract serious flows, do well? Will other fund families attempt to sort of replicate, come up with their own ARKs and sort of make bets on the idea of actively managed stock picking star portfolio managers again?
Possibly a little bit. The problem with all these big active shops, they can't do this. They just aren't. It's not in their DNA to be this risky and this concentrated.
Right.
Cathie left AllianceBernstein because they wouldn't let her be this free. And so I don't think you'll see anything quite like it. What you are seeing, though, is copycats in terms of like theme ETFs that are disruption and theme oriented. And we are seeing a little bit of a tick up in the active share of new launches. In other words, how concentrated they are, it really increases their pop potential. So I do think you will see ETFs coming out that are designed to have that max pop potential, but I don't think you'll see them from traditional active managers.
Talk to us about, I guess, some of the old guard out there. Vanguard got a lot bigger this year. It continues this streak here. What's the story?
Yeah, we just talked about ARK's big year. Vanguard took in 10 times what ARK did with $200 billion. So all the real money is going to Vanguard and BlackRock as usual. What's interesting about Vanguard is they beat BlackRock for the first time ever. And if you think about Vanguard and BlackRock, I think what we're going to see going forward is a lot of consolidation. I think all the money going to them is going to stuff that's like charges less than 10 basis points. It's really making the asset management industry very difficult in the future. And I think you're going to see people team up, go vertical, and try to own the customer, buy advisors. It's going to be interesting over the next couple of years. I will say one quick thing. VTI, the total market ETF, we really like this one. It's after S&P took in Tesla late, we think that people might look to the total market funds more because it's held Tesla for 10 years. And I think the S&P 500 took a hit to their brand, and they saw outflows as a group this year for the first time ever.
Let me ask you, the other big phenomenon that we saw, one of the other big stock market phenomenons we saw was just the explosion of retail investor, individual stock picking, stock trading, trading options, a lot of it associated with Robinhood, but the other brokers too, especially as they slashed commissions. This is in market divergence of the sort of mantra that had been sort of slammed into everyone's heads for the last decade of don't try to beat the market, just focus on low fees, indexes, ETFs. Does that create a little tension, more and more investors maybe thinking they can do it on their own and not just being willing to accept the index returns?
Yeah, I think so. I think when the market's doing this well, it makes everyone pretty confident.
Right.
The way I put it is a lot of those Robinhood investors and the people you see on FinTalk are actually future Vanguard investors. They just need a crash to sort of straighten them out a little bit. I think, when you have a market where everything goes up and you can make this kind of money, it's very easy to be that way. I do think this happened in the late 90s. It just echoes for me as a Gen Xer what I saw in the late 90s. And a lot of those people ended up going the sort of buy and hold index route. That said, I do think the Robinhood crowd is a big reason ETFs had 32 trillion in volume, especially they like the leverage stuff. TQQQ was in the top 5 most traded for the last half of the year. I also think they like the USO ETFs back in June. And they really like these, sort of interesting theme ETFs like BETS, EDOC, work from home. So we are seeing ETF issuers now cater straight to that Robinhood crowd and skip the advisors. So right. I do think they are real and they are here to stay for sure.
I want to ask you just a broader question here, Eric, about the way that ETFs are used, not by the retail traders, but by some of the institutions and how much that sort of played into some of the gains and some of the flows that we've seen. A lot of institutions, a lot of portfolio managers really using ETFs to make to take whatever position they want to take in the underlying stocks.
Yeah, we saw this in March for sure. When the March sell-off, I would say when the going gets tough, ETFs get going. The volume for especially fixed income ETFs in March is normally what they do in a quarter. So it's like they squeezed in a quarter's worth of trading, and that's because they're liquid. People look for them to adjust their portfolios. That's why ETF volume sometimes goes together with volatility and fear. And so we tend to see that. But, yeah, that's what the institutions use. They're using HYG, LQD, SPY to get instant, quick exposure, almost like we call them pseudo futures. And that is, alive and well.
All right, Eric, have a great new year. We'll catch you on the other side. Eric Balchunas of Bloomberg Intelligence, of course, talking about one of the big themes for the year, where, of course, that's the focus of our show today. Another big theme of the year, believe it or not, Joe, politics. You can believe it. The U.S. presidential election, Brexit.
I remember that.
I know, a lot of big political themes out there this year. We're going to talk with Tina Fordham coming up next. She's a partner and head of global political strategy over at Avonhurst. That's coming up after the break. This is Bloomberg. All right, welcome back to What'd You Miss, the final program of 2020. And so we're focused on the big themes of 2020 and some of the themes of 2021. Credit, Joe, that was actually a big story this year. In fact, a lot of people thought credit would be a loser. Turned out to be a pretty big winner for a lot of folks.
Yeah, once again, of course, not what people would have expected. We saw that massive sell-off, dislocation in March. Anything credit sensitive blew out. Look at the yield to worst of the Bloomberg Barclays high yield index surging a bunch, 12% spreads, but having come down quite a bit, very narrow spreads, not a lot of premium there if you're looking to take a risk in credit. So the question is, where do you make money? So joining us with more insight is Family Management Corporation Chief Investment Officer David Schawel. David, thank you so much for joining us. So everything looks pretty expensive by conventional metrics. You look at stocks, they look pretty expensive. You look at credit, spreads are kind of narrow. You look at risk-free assets, yields, very low by historical standards or just objectively. How are you thinking about identifying opportunities in 2021?
Well, thanks for having me on. But I think the first thing is just stay away from making the big mistake. And I think the big mistake next year is chasing the high-flying assets. So chasing the SPACs, chasing the hottest momentum plays. I think that, in a winner-take-most market, the chances that the average investor is going to be picking those correctly, especially after a huge run-up, is going to be very small. So I think just avoiding large mistakes is the first thing. I think the second thing is really getting on board with the cyclical recovery. So we're in a market that's probably going to, the U.S. is going to grow real GDP probably north of 5%. globally, it's probably going to be north of 6%. So we're really in a market that's pricing in a recovery. And I just think applying the playbook from 2020 is not going to be the way to go for next year.
So when we talk, David, about, I guess, avoiding mistakes, I mean, one problem that a lot of investors are going to run into is that it seems like so many asset classes out there right now are either at record highs or they've at least appreciated by a significant amount over the course of the year. So how do you sort of find, opportunities when it seems like all those opportunities have already paid off?
Right. I mean, it's a good question. I think, within, for instance, technology, it might not mean abandoning technology completely, but that doesn't mean you have to chase the next SaaS company that's trading at 30 times multiple of revenue. I think what's happened is as the markets continue to go up, investors have increasingly taken more and more risk. So in March, it was, should I get back into the S&P? And then in April, it might have been, maybe I'll get into the NASDAQ. And then, should I buy Tesla? And now it's, should I buy an electric vehicle company or a SPAC? So I think really keeping your head down and focusing on companies that really have a path to sustainable growth, and also where you can actually make money from these valuations. So, there might be areas within technology that are rich, but there might be certain segments which still have value. For instance, Facebook, if you go out a couple of years, is still trading at a mid-teens multiple, whereas there's other companies which are really pricing in a bar that's really hard to eclipse. And then I think, just moving into cyclical recovery, I think areas that have been beaten down the last year, banks, emerging markets, value stocks, I think all are a place where you have to have some exposure next year.
Talk to us a little bit more about this sort of phenomenon of people taking more risks. I mean, there were so many opportunities in retrospect to have made an absolute fortune this year, whether it's in cryptocurrencies, notably Bitcoin, Tesla, all these SPACs. In your conversations with clients and people you work with, did you hear that attitude change in real time? Like, how are those conversations over the last few months in terms of them thinking about having missed out and wanting to, take bigger swings next year?
Right. And I think, the mentality switches from, how much downside is there to am I participating now to, am I missing out? And, a lot of conversations with, have I missed Bitcoin? Should I be in this SPAC? So I think that the mentality gets dangerous because the thought process is completely removed from any value and what the downside could be, and is entirely in how much have I missed, or how much upside is there? Can I get the next double? So I think that type of psychology is very dangerous. And I think that, this market, quite a year, but it can promote some pretty dangerous investing habits.
When you talk about things like, oh, maybe this is a good time to buy value or have exposure to banks, which banks have rallied from the bottom, but still nothing near it. Is that a difficult thing for people to swallow? And what is the case other than that they're really beaten down for some of these sectors?
Well, I think in the case of financials, the bar is lower. So, maybe with a software stock, you need everything to go right and then to beat expectations by a substantial margin. Whereas banks, the bar is, somewhat low. Maybe what they need to have happen is that the Fed to lift the cap on buybacks, slightly earlier than expected. Maybe it's that interest rates just, tick up ever so slightly. They don't need to go up 100 basis points, but even a gradual climb on the long end will help them out. Maybe it's just the, flows. Flows are a big determinant of what's in the last year. We've seen flows into a lot of the high flying stocks, but what tends to happen is price leads sentiment. So when we start to see JP Morgan and Wells Fargo and Silicon Valley Bank and all these banks start to move up, what can happen is momentum investors and flows can start going into a segment which really had negative flows for quite a long time.
What's the lesson here then for the Fed? Going forward, at some point, they've got to normalize policy, you would think. At some point, they're going to have to confront inflation, you would think. But, is there a lesson to be learned from the efforts that they took this year to stabilize markets?
I think they did what they needed to do. We're in unprecedented times, and I think going forward, one question for fixed income investors and equity investors is how much do you trust the reaction function of the Fed? Right now, they've said that they're going to leave rates low, for a prolonged period of time. But I think the risk is kind of to the upside. So if a lot of assets are pricing in that the Fed is going to be, people of their word, but things, we tend to, maybe we have a year or two of really hot economy, those conditional probabilities can change. It might go from a 5 to 10% chance that they'll stay, that they could move off at the bottom to, a 30 to 40% chance. And when that happens, asset prices can react pretty substantially, which is why I think that having some exposure to a cyclical recovery, non-US stocks, emerging market stocks, value stocks, I think you need to have some of that in your portfolio for 2021.
All right, David, great stuff. We'll catch up with you hopefully soon in 2021. Have a happy new year. David Schawel is the CIO at Family Management Corporation. We'll be back in a moment. This is Bloomberg. All right, today we are focused on the year ahead, Joe, but before we get too deep into 2021, we still got some unfinished 2020 business to deal with, and of course, that's the Senate race down there in Georgia.
They're still doing this, huh? Okay, so vote coming up next week, and the momentum, it appears, according to the polls, there's the 538 poll average. John Ossoff slightly leading incumbent Senator David Perdue by about 1%. I think in the other one, Raphael Warnock also leading slightly his opponent, the incumbent Kelly Loeffler. So this is big because this could be control of the Senate. If the Democrats pick up both, they get 50 seats. With the Harris tiebreaker, that gives them control of the Senate. So the stakes are very massive for next Tuesday.
Yeah, they absolutely are. Let's bring in Tina Fordham. She's partner and head of global political strategy over at Avonhurst. It's a political and legal advisory boutique over there in London. Formerly, she was the chief global political analyst over at Citigroup, the first person on Wall Street to hold that role. Tina, great to have you back here on the program. Let's start off with, I guess, the U.S. Senate and really, I guess, the general makeup of the U.S. government here in about 3 weeks or so times when Biden finally is inaugurated and we see the new Senate, a new Congress. What's the general outlook here for whether anything will be able to get done?
Well, as everybody knows, we now have yet another big political signpost on January 6th with the Georgia race. As Joe just flagged for us, both seats are within the margin of error. Very, very close, but the street very much seems to have come down on the side of Republicans holding those two seats. Now, I don't see any reason to necessarily challenge that consensus wisdom. But what we know about polls in general and what we know about predicting Senate races in particular is that the record is poor. So in that sense, I think that a victory for Republicans in one or both seats might see a bit of a relief rally. But there's a very good chance the Democrats could win one of those, if not two. So here we have, almost a mini referendum on the 2020 election. It's extraordinary in U.S. terms. And of course, there are questions about whether President Trump is actually trying to sabotage Republicans' prospects.
Bigger picture, okay, so we don't know what's going to happen on Tuesday. It's probably going to be close regardless. The direction of politics in this country, the election of Joe Biden, kind of a throwback to, it seems like a more normal time of politics than we're experienced. But the broader direction, is it still towards more polarization, more extremes, more crazy?
More crazy. Well, the most typical question I get from global investors, being outside of the U.S. as I am, is really this: is America going to be a normal country again?
Yeah.
And it's within U.S. investor in themselves that focus on tax and regulation and everything else. The United States resuming something like a normal posture would be very welcomed in global business and amongst global leaders. But I think hopes are probably too high about what a Biden presidency can do and will do, given the extent of the domestic crisis with COVID.
Tina, I want to get your thoughts here. I mean, Trump sort of came into the office, at least on what was characterized as kind of a populist wave of sentiment. We saw that that perception of populism also lift a lot of folks to leadership posts over in Europe as well as in Asia. We also saw a lot of protests in the years prior over in the Middle East. I am curious as to whether that sort of populist uprising, and at least just the general sentiment around it, has that actually run out of steam?
Well, there was a big question about whether 2016 was kind of peak populism. And as you know, that's a topic I follow closely. We had the referendum to leave the EU here in the UK, and of course just had the Brexit vote yesterday. And 4 years after Trump did not get a second term. He's probably a casualty of the pandemic in that sense. But we should think of populism as part of the political furniture. And I think that this is important. Of course, markets tend to fear left-wing populism with all of the expectations and fears of tax raising that comes with it. The market's been pretty relaxed about right-wing populism. But one of the things that I am flagging in my outlook is what I call Vax Populi, playing on my Vox Populi theme, looking at the idea that not only is the vaccine rollout going to probably be more erratic and prolonged than markets expect, but that there is historical precedent for this kind of a trauma from a health and an economic perspective, actually kind of booby-trapping the future and leading to more prospect for political extremism in future elections. Perhaps not, this year, but in the U.S. midterms, or even, I would argue as a political scientist, 5 to 10 years out. So the legacy of this, we've all been talking about how, the market's not the economy. Well, people are still going to vote on the basis of the economy.
All right, great stuff. Always enjoy talking to you. Got to do it more next year. Our thanks to Tina Fordham, Avonhurst partner and head of global political strategy. So, Romaine, what are you watching next year? What's your big story
Next
of 2020?
year?
Yeah, what are you watching?
Oh my gosh, Joe. I don't think I'm going to be watching anything. You know what I'm going to be watching? What'd you miss?
I'm going to be saying, I'm going to see what Tesla does.
I got nothing, but we made it to the end of the year. It's been wonderful.
Yeah, we don't need to think about next year.
Are you coming back next year?
I'll be back.
All right, that's all for What'd You Miss. Bloomberg Technologies coming up next.
Have a great evening, great New Year's Eve. This is Bloomberg.